think back, maybe 2007, 2008, the housing market, right? Built on, well, shaky foundations.
Yeah, it was collapsing.
Exactly. And it sent these huge shockwaves through the whole financial system. Trillions just gone, mostly tied up in residential mortgage-backed securities, RMBS.
The painful memory for a lot of people.
No kidding. And now, fast forward, we're in a different kind of uncertain time. The causes are different, global stuff, market shifts.
But you're seeing parallels.
Yeah, unsettling echoes, I guess. But this time, the focus feels more on commercial real estate and the complex financial things tied to that.
CMBS.
Right, commercial mortgage-backed securities. And we're talking big money here, something like $500 billion outstanding in the U.S.
It's a huge market.
And the forecasts, especially around when our source material was looking at this stuff, painted a pretty worrying picture.
Delinquency is spiking.
Yeah, big time, especially in retail and hospitality. The prediction was they could hit levels we hadn't seen since the Great Recession.
Wow. Do you have numbers on that?
Yeah. Fitch was forecasting something like an 8.75% overall CMBS delinquency rate by late 2020. But sector-specific, it was much higher.
Let me guess. Retail and hotels.
You got it. Retail potentially hitting around 23% delinquent, and hotels an alarming 31%.
Oof. That's serious distress.
Exactly. So today we want to pull back the curtain on the CMBS world because they're not simple investments, right? They're intricate.
Very intricate.
And to really get a handle on the risks potentially hiding inside them, you need to understand how they're built, how the risks get sliced up and layered.
That's the key, the structure.
And the core idea we really need to unpack is tranches.
That's absolutely right.
Yeah.
When you look at how commercial real estate connects to the wider financial system,
Right.
CMBS are a really significant link.
Yeah.
Sometimes not very transparent either.
Right.
And the way potential losses and also the cash flows get distributed inside these things, well, that's fundamental. It tells you where instability might pop up when the loans underneath start having trouble.
And more importantly, who gets hurt when that happens.
Exactly. Who's holding the bag?
Okay, so what are we using for our deep dive today? We've got a pretty interesting mix of sources. There's some fascinating analysis from legal experts.
Looking at potential lawsuits.
Yeah, exactly. They were looking at the wave of litigation that market distress, like the kind predicted back then, could unleash on these complex structures.
Makes sense. Stress tends to breed lawsuits.
Totally. And we've paired that with more sort of foundational stuff, pieces that just explain the nuts and bolts, how CMBS are put together, the regulations, the mechanics behind it all.
It's a good combo. You get the architecture, but also how that architecture reacts under pressure.
Yeah.
Because these sources don't just describe CMBS, they give you insight into the weak points. The places where conflicts pop up when borrowers struggle and the money gets tight.
Which makes you ask, how strong are these things really? And when they buckle, who takes the hit?
That's the million-dollar question, or maybe the billion-dollar question.
Yeah. Maybe. And that brings us right to our mission for this deep dive. We want to give you a clear, comprehensive picture of what CMBS actually are.
Okay.
How their unique payment structures, these tranches, work to hand out both the cash flow and, crucially, the risk.
The allocation piece.
Right. We'll look at the specific risks they face, how big regulatory changes like risk retention have changed the game.
Dodd-Frank stuff.
Yeah. And finally, how market stress, like our sources were highlighting, just makes all these risks worse and creates, a breeding ground for legal fights.
That was good.
The goal is really just to give you a much sharper picture of these risk layers in the whole commercial real estate finance world.
Okay, let's do it. Where should we start? The absolute basic.
Yeah, let's lay the foundation. What is a CMBS?
Okay, so fundamentally, it's a type of bond, a security, that's backed by a pool, a collection of commercial mortgage loans.
So instead of a bank holding just one big loan on, say, a shopping mall.
Right, or an office building.
Yeah.
They, or other lenders, bundle a whole bunch of these commercial property loans together.
Okay.
Then this bundle gets effectively repackaged, and pieces of that repackaged bundle, they're sold off to investors as bonds.
And the investors get paid from
the property owners making their mortgage payments. The interest and principal they pay on those underlying commercial loans flows through to the bondholders.
Got it. So it takes these big, maybe hard to sell individual loans and turns them into something investors can buy and trade more easily?
That's the magic of securitization, exactly. It takes these typically large, relatively illiquid commercial loans and transforms them through pooling and structuring into tradable securities for the capital markets.
Okay, so walk us through that process. How does it actually happen?
Sure. So it starts with the originators. These are usually banks or other lending institutions. They're the ones making the actual loans to the borrowers, the people or companies that own the office buildings, the hotels, whatever.
Okay, the loan gets made. Then what?
Then those originators typically sell the loans. They sell them to a sponsor or an issuer.
And the sponsor's job is?
Their job is to gather up potentially hundreds of these individual commercial loans from different originators and pool them together.
Okay, create a big pile of loans.
A big, hopefully diversified pile. But the sponsor doesn't hold on to this pile directly. They put it into a special legal entity, usually a trust. It's designed to be separate, bankruptcy remote.
Ah, for safety.
Right. And it's this trust that actually issues the CMBS bonds. These bonds represent the right to receive the cash flow coming from that pool of loans.
And then those bonds get sold.
Yep, sold off to investors in the capital markets, pension funds, insurance companies, maybe hedge funds, a whole range of buyers.
Okay. And the loans themselves, what kind of properties are we talking about backing these things?
A real mix, usually. The sources mentioned the big categories: multifamily apartment buildings, office towers, industrial properties, think warehouses, logistics centers, then retail, which could be anything from big malls to small strip centers and hotels. Plus, you sometimes see other categories or things like healthcare facilities.
And the mix matters, right? Like how much is in retail versus office?
Hugely important. One source gave a snapshot from January 2017. In that sample pool, retail was actually the biggest chunk, over 28%. Office was next at about 25%, and multifamily was around 16%.
That's interesting because, as we saw, retail and hotels got hit really hard recently.
Exactly. Some property types are just way more sensitive to economic shocks or, changes in how people shop or travel.
So, do they try to spread the risk?
Oh, definitely. Diversification is key. They aim to spread the loans across different property types and also different parts of the country. That helps reduce concentration risk.
But you could still end up with a big exposure to a sector that suddenly becomes vulnerable.
Absolutely. Even with diversification, a major hit to a big sector like retail can still cause significant problems for the CMBS deal.
Okay, who else is involved besides the borrowers, originators, issuers, trust, investors?
Good question. There are a couple of other key players. You've got the primary servicer.
What do they do?
They're kind of the day-to-day managers. They collect the monthly payments from the borrowers, handle the basic loan admin stuff, and pass the money up to the trustee.
Okay, standard loan servicing.
Right. But then there's the special servicer.
Sounds important.
Very important. They step in only when a loan gets into trouble. If a borrower misses payments, looks like you're going to default, or actually defaults.
The special servicer takes over that loan.
Exactly. Their job is to manage that problem loan and try to get the most money back for the trust. That might involve modifying the loan terms, foreclosing on the property, or finding some other way to resolve it.
Okay, I can see how that role could get really crucial, maybe even controversial, when the market gets rough.
Definitely. We'll likely come back to them. They sit at a critical junction when things go wrong.
And then, of course, the investors holding the bonds.
Right. The ones ultimately hoping for that steady stream of income from all those pooled mortgages.
Okay, foundation laid. Now let's get to the really interesting part you mentioned. The tranches and the payment waterfall. This is how they manage the risks, right?
This is absolutely central. So the bonds, the trust issues, they're not all the same, not even close.
Different flavors.
You could say that. They're explicitly designed and issued in different classes or tranches. Picture that stream of cash coming in from all the loan payments.
Yeah, okay.
Now imagine slicing that stream horizontally into layers. Each layer is a different tranche.
And these layers are different.
Critically different. They have different levels of seniority, different credit ratings, and crucially, they get paid in a very specific, predetermined order.
An order of priority.
Exactly. It's called the payment waterfall.
Yeah.
All the money collected from the borrowers flows into the trust.
Like water into a fountain.
Good analogy. And then it spills downwards through the tranches, following a strict priority list. The tranche at the very top, the most senior one, gets paid first.
It gets its full scheduled payment.
It's full interest and any scheduled principal. Once that top tranche is paid, whatever cash is left flows down to the next most senior tranche. That one gets paid, then the next, and so on.
All the way down to the bottom layer.
All the way down to the most junior or subordinated tranche sitting at the very bottom of the waterfall.
So if there's enough cash flowing in from the loans, everybody in the waterfall gets paid in order.
Correct.
But if the cash flow dries up a bit, if some borrowers don't pay.
Then the pain starts at the bottom. The lower tranches are the first ones to not get their expected payment. The shortfall hits them first.
Okay. So this structure creates like an inverse relationship between how senior are tranches and its risk.
Precisely. Inverse relationship between seniority and risk return. The tranches at the top, the senior ones, highest payment priority.
Safest.
Safest. And just as important, they are the last ones to take a hit, yes. Losses eat their way up from the bottom. This high payment priority and loss protection means senior tranches have better credit quality, often rated investment grade, like AAA.
That's the trade-off.
Lower return. Because they're safer, they offer investors lower interest rates, lower yields, or coupon payments.
Makes sense. Lower risk, lower reward.
Standard finance principle. Now, flip it. Go down to the bottom of the waterfall, the most junior or subordinated tranches.
Lowest payment priority.
Lowest payment priority, and they are the first to absorb losses from defaulted loans. If a property gets foreclosed on and sold for less than what's owed on the loan,
that loss amount gets taken out of the bottom tranche first.
Exactly. That loss hits the very bottom layer of the CMBS capital structure immediately.
Right.
Only if that entire bottom layer is completely wiped out, loses all its value.
Then the losses start moving up to the next layer.
Correct. Then losses start creeping up the waterfall, hitting the next tranche above it, and so on.
So the junior tranches are way riskier.
Significantly riskier. They're essentially the shock absorbers for the whole structure.
So why would anyone buy them?
The potential return. To compensate investors for taking on that much higher risk, for being that first line of defense, these junior tranches have to offer much higher potential yields. High risk, potentially high reward.
Got it. So if enough loans go bad and property values tank, the losses just chew through the structure from the bottom up. Junior guys get wiped out first, then the mezzanine, before the seniors feel anything.
That's the fundamental design. Protect the senior bondholders by concentrating the initial losses on the junior bondholders.
It's a clever way to distribute risk, definitely. But it creates these really distinct layers of risk all tied to the same pool of mortgages.
Absolutely. And the design itself has evolved. Our sources talk about the difference between deals done before the 2008 crisis and those done after.
Legacy CMBS versus CMBS 2.0.
Exactly. Legacy CMBS are the ones issued roughly before 2009. CMBS 2.0 are the ones that came later, supposedly incorporating lessons learned.
And the legacy ones didn't fare so well in the crisis.
Not always. The sources note they suffered really heavy losses in some cases. Losses sometimes went surprisingly high up the capital structure, even hitting tranches rated AA, or A, the senior mezzanine layers.
So even layers that looked pretty safe weren't totally immune back then.
Right. It showed that severe systemic stress could break through those protections. So CMBS 2.0 were meant to be tougher.
How so? Better loans.
Generally, yes. The loans pooled in post-crisis deals were often seen as less risky from the start. They tended to have better underwriting metrics, things like lower loan-to-value ratios.
Meaning more owner equity in the property.
Exactly. And higher debt service coverage ratios, or DSCRs.
Meaning the property's income covered the debt payments more easily?
Correct. More cash flow cushion. So better perceived loan quality was one piece.
Were there structural changes, too, inside the CMBS itself?
Yes. Increased credit enhancement, basically more protection built in for most tranches. One specific change mentioned was getting rid of the junior AAA bonds.
Junior AAA sounds contradictory.
It kind of was. They were rated AAA, but they were still behind other AAA tranches in the payment order. It added complexity. CMBS 2.0 aimed for clearer lines of seniority, trying to simplify that top layer.
So the market and the regulators tried to build a stronger mousetrap, learning from the weaknesses the crisis exposed.
That was absolutely the intention. But, as we'll discuss, even with improvements, market stress can still find vulnerabilities and create, well, new kinds of problems, especially legally.
Okay. Before we get into all the potential problems, maybe quickly clarify the differences between CMBS and the residential kind, RMBS. They sound similar but aren't the same.
Good idea. Obvious difference first. The loans underneath. RMBS, as the name says, is backed by mortgages on people's homes, single-family houses, maybe small 2- or 4-unit buildings.
And CMBS.
Commercial and multifamily properties. The offices, shops, hotels, big apartment complexes we talked about. Different underlying assets entirely.
Okay, different collateral. What else? The sources mention differences in the information about the loans.
Yeah, this is pretty important, especially if you're thinking about problems later on. The legal documents for CMBS deals, while detailed, often have fewer or maybe narrower promises, representations, and warranties about the underlying loans compared to what was common in RMBS.
Meaning?
Well, for example, CMBS documents typically don't promise that every loan followed a specific, detailed set of underwriting rules the way many RMBS deals used to.
So maybe less certainty about exactly how each loan was approved.
Could be. And the data provided might differ too. RMBS loan files often had specific things relevant to homeowners, like debt-to-income ratios, DTI, and loan-level LTV was common.
And CMBS data?
Might be more aggregated, pool-level stats, or if you get loan-level data, it focuses on commercial metrics. Things like debt service coverage ratio, DSCR, the property's income versus its debt payments, and net operating income, NOI, which is the property's income before debt service, and LTV, of course.
Got it. Different metrics, maybe less granular detail available on every single loan for investors digging in. What about the number and size of the loans?
This is probably the biggest practical difference, with huge implications. RMBS deals, thousands, sometimes tens of thousands, of relatively small home loans. Your average mortgage might be, a few $100,000?
Okay, lots of small loans.
So if one homeowner defaults, it barely moves the needle on the whole pool's performance.
All right, and CMBS?
Totally different picture. Far fewer loans in a typical deal, maybe just a couple hundred. But each individual loan, much, much bigger.
How big?
Often over $10 million. And you get these mega loans that can be well over $100 million, just one loan.
Wow. Okay, that is a dramatic difference. Fewer loans, but each one is a huge chunk.
Exactly. That's concentration risk baked into CMBS. And think about what that means for disputes.
Easier to fight over one big loan.
Precisely. In RMBS, you often had to show problems across thousands of loans to make a lawsuit worthwhile. In CMBS, a fight over one single large defaulted loan, say a $50 million one, can be economically viable and have a major impact on the deal's performance in multiple tranches.
That makes total sense. The failure of one big commercial loan sends much bigger ripples through a CMBS pool.
Absolutely. Okay, so now let's talk about the specific risks these things face, especially when the market gets stressed, like the sources were describing back in 2020, when those delinquency predictions start coming true.
Right. What kind of defaults actually happen with these commercial loans?
The sources mention two main types. First is a term default. Pretty simple. The borrower just doesn't make a payment they're supposed to during the loan's term. They miss their monthly interest or principal payment.
Okay, straightforward non-payment. What's the other?
A maturity default. This happens because of how many commercial loans are structured. Often they have what's called a balloon payment.
Meaning?
Meaning the borrower might pay only interest for the loan term, or maybe payments based on a long amortization schedule, like 25 or 30 years.
Yeah.
But the entire remaining principal balance becomes due all at once after a much shorter period, maybe 5, 7, or 10 years.
A big lump sum payment at the end.
Exactly. A maturity default is when that balloon payment comes due, and the borrower can't pay it. Usually because they can't get a new loan to refinance the old one. Market conditions might be bad, or the property isn't performing well enough to support new debt.
So even if they paid perfectly for 10 years, they can't make that final huge payment, boom, default.
That's it. And what causes these defaults generally?
Well, the sources mention things like the borrower getting into legal trouble that drains their resources, or, more commonly,
The property just isn't making enough money.
exactly, not enough net operating income, NOI, to cover the debt payments comfortably. If the tenants leave, or rents fall, or operating costs go up too much, the cash flow just can't support the loan.
Right. Now here's a really critical point the sources make. A loan defaulting doesn't automatically mean the CMBS investors lose money, right?
Yeah, that's important. Why not?
Because the loan is secured by the property itself. It's collateral. So if a borrower stops paying, the special servicer usually steps in. They might eventually have to foreclose and sell the property. The actual loss to the CMBS trust, and therefore to the bondholder starting at the bottom, only happens if the money they eventually get back from selling or liquidating that property is less than the outstanding loan balance.
So the loss severity depends on the property's value at the time of sale.
Exactly. If they recover the full loan amount or even more, there's no loss to the bondholders on that loan. If they recover less, the difference is the loss that hits the waterfall.
Okay. Which brings us back to the context of our sources, mid-2020. They were expecting a lot more defaults and potential losses.
Yeah, it was a moment where the market was really bracing itself. The pandemic shutdowns, the travel restrictions, the economic disruption was sudden and severe.
And the expectation was delinquencies would climb fast.
Very fast. That Fitch forecast we mentioned, potentially hitting 8.75% overall delinquency by October 2020, That was a sharp projected rise.
And for those really exposed sectors like retail and hotels, the numbers were much worse.
Much worse. Retail projected around 23% delinquency, hotels around 31%. Student housing, some office, some multifamily, were also seen as very vulnerable. It was a grim outlook for certain property types.
And the sources also pointed out that these numbers might actually understate the problem at first because of forbearances.
That's a really key nuance. Forbearance is when a lender lets a borrower temporarily pause or reduce their payments without officially calling them delinquent.
Kicking the can down the road, basically.
Sort of. It provides temporary relief, which can be crucial, but it means the loan isn't counted in the delinquency stats right away, even though the borrower can't actually make the original payment. It masks the underlying distress for a while.
And the sources also noted that at that specific time, commercial mortgages weren't getting much help from the big government relief packages.
Right. Unlike, say, the residential mortgage market or other parts of the economy that got direct stimulus or support, the commercial mortgage market was largely left out initially.
Except maybe some multifamily.
Yeah, if the multifamily property had a federally backed mortgage, like from Fannie Mae or Freddie Mac, they could potentially get forbearance under the CARES Act. But for the bulk of CMBS loans, backed by offices, retail, hotels, not so much direct federal help at that point.
So less of a safety net compared to the last crisis, maybe.
In some ways, yes. That lack of broad stimulus was seen as a factor that could make delinquencies rise even faster, potentially pushing the overall CMBS rate past the previous peak seen back in 2012, which was around 10.3%.
Okay, so besides the risk of outright default and losing principal, what other headaches can pop up for CMBS investors when loans get stressed?
The sources flag a couple of other key risks. One is interest shortfalls.
Affecting coupon payments.
Yes, especially for the lower junior tranches. Remember, they get paid last. So if the total cash coming into the trust drops, maybe because some loans got modified to pay less interest for a while, or because liquidating defaulted loans takes time and costs money, there might not be enough cash left to pay the full scheduled interest to everyone after the senior tranches get theirs.
So junior bondholders might see their interest payments cut even before any principal losses are realized.
Exactly. They're last in line for everything. The other risk is extension risk.
Related to maturity defaults.
Often, yes. If a loan hits its maturity date and the borrower can't refinance that balloon payment, the special servicer has to decide what to do. Foreclosing immediately might not get the best recovery, especially in a bad market.
So they might give the borrower more time.
Right. They might grant an extension, maybe a year or two, hoping the borrower can eventually refinance or sell the property under better conditions.
Which might be good for maximizing recovery eventually.
Potentially. But it means the CMBS bondholders who are expecting their principal back on that original maturity date, they don't get it. Their principal repayment gets delayed or extended.
Which messes up their own cash flow planning.
Correct. It ties up their capital for longer than they expected. So you see, stress on the underlying loans creates this whole cascade of issues, payment shortfalls, delayed principal that affect different tranches differently as it flows up the waterfall.
Definitely a complex web. All right, let's shift gears a bit. How has regulation tried to make the system safer, more resilient? You mentioned risk retention earlier.
Right. This was a really big deal coming out of the financial crisis. The Dodd-Frank Act back in 2010 included a rule specifically for securitizations like CMBS.
What did it do?
It mandated that the issuers, the ones putting the CMBS deals together, have to keep some skin in the game. They have to retain at least 5% of the credit risk of the deal themselves.
So they can't just originate or pool loans and sell off 100% of the risk anymore.
Exactly. The idea is to align their incentives with the investors buying the bonds. If the issuer knows they will lose money if the loans go bad, they should, in theory, be much more careful about the quality of the loans they put in the pool in the first place.
Better underwriting, fewer risky loans.
That's the goal. The issuer typically has to absorb the very first losses that hit the deal, up to the amount of risk they've retained.
So they act as the first buffer, taking that initial 5% or whatever it is, hit before the bondholders lose anything.
That's the basic design. Now, the rules gave issuers a few different ways they could meet this 5% requirement. Our sources outline three main methods.
Okay, what are they?
The first is called vertical retention. Here, the issuer keeps exactly 5% of every single tranche they issue.
So 5% of the AAA, 5% of the AA, 5% of the BBB, all the way down.
Yep, like taking a thin vertical slice through the entire capital structure. They share proportionally in the risk of every layer. and they have to hold on to this vertical strip for a long time, usually until the deal pays down significantly, which could be 10 years or more.
Okay, shared risk across the board. What's the second option?
Horizontal retention. This is probably more common in CMBS. Here, the issuer retains, or more often sells, to a qualified third-party investor the most junior, riskiest piece of the deal.
The very bottom tranche.
Usually the bottom tranche, or tranches, yes. This piece has to represent at least 5% of the fair value of the whole CMBS deal.
Not face value, fair value.
Right, fair value. It's a bit more complex, meant to reflect the actual risk economics. This bottom piece is often called the B piece.
And who buys this B piece?
Specialized investment firms, often called B-piece buyers. They're experts at analyzing the riskiest part of CMBS deals and are willing to take that first loss position in exchange for potentially higher returns.
And there are rules for them too.
Oh yeah. The B-piece buyer has to hold onto that horizontal slice for at least 5 years. They have to pay cash for it and meet other criteria to make sure they're independent and truly exposed to the risk. They become that 5% first loss buffer.
Okay, so either the issuer takes a slice of everything, vertical, or someone takes the whole bottom slice, horizontal. What's the third way?
It's a hybrid. L-shaped retention, basically a combination of the first two. The issuer might keep a smaller vertical slice, and then there's also a horizontal slice, maybe sold to a B-piece buyer, so that the total risk retained between the two pieces adds up to at least 5%.
Got it. Flexibility, but someone always holds that first 5% risk. Has this actually worked? Has it changed lending?
Well, according to one of our sources citing academic research, there is evidence suggesting it has. The research found that deals subject to risk retention rules tend to have underlying loans with slightly higher interest rates for the borrowers,
Okay.
but also more conservative underwriting.
Meaning safer loans.
That's the idea. Things like higher DSCRs, more income cushion, and lower LTVs, more equity cushion. The implication is that knowing they have skin in the game is pushing issuers to be pickier about loan quality.
That makes intuitive sense. If you might have to eat the losses, you'll be more careful up front.
Exactly. And interestingly, the research also noted that the amount of risk being retained in practice, especially via the horizontal B piece, was often substantially more than the required 5%.
Really? Like how much more?
The source mentioned an average B piece size in recent deals being around 10.3% of the deal's face value. That's double the minimum requirement and much higher than typical retention levels before the crisis.
So the market itself seems to be demanding an even bigger cushion than the regulation requires.
It seems that way. And it's also made the amount of retention more consistent across deals. The 5% rule seems to be a real floor that everyone adheres to, reducing the variability we saw before.
Okay, interesting. So we have the structure, the risks, the regulatory overlay. Now let's dive into the messy part. What happens legally when things do go wrong? When loans get stressed, like the sources predicted, the legal experts highlighted several kinds of disputes, right?
Yeah, and it's fascinating how the structure itself, combined with financial stress, creates these specific flashpoints for legal battles.
Let's start with control disputes and conflicts of interest. Sounds juicy.
It can be. So in a CMBS deal, a lot of power, especially over handling troubled loans, traditionally rests with a specific group of junior bondholders. They're called the controlling class.
Usually the B-piece buyer in a horizontal retention deal.
Often, yes, or the holders of the most subordinate tranches. Because they're first in line for losses, the thinking was they should get to call the shots on fixing problem loans. They typically have the power to hire and fire the special servicer.
The one who manages the defaulted loans.
Right, and approve the special servicer's workout plans. Basically, they steer the ship when it comes to distressed assets.
Okay, makes sense the ones with the most at risk get control. But where's the conflict?
The conflict arises, especially in the older legacy deals, if that controlling class holder finds themselves underwater, meaning the losses on the deal are already so bad or projected to be so bad that their investment is likely going to be completely wiped out anyway.
So they have nothing left to lose from the loan recovery itself.
Exactly. But they might still hold the control rights. And in that situation, their incentive might shift. Instead of trying to maximize the recovery for everyone in the trust, including the senior bondholders,
I might do something else.
they might be tempted to maximize fees for the special servicer, especially if they have some kind of affiliation or fee-sharing deal with them. Or they might push for workout strategies that benefit their other business interests, even if it means less money recovered for the trust overall.
Wow, okay. That's a clear conflict, making decisions to benefit themselves or their affiliates, not the trust as a whole.
Precisely. The sources mentioned some cases like L&R Partners versus C3 Asset Management. that involved complex fights over these control rights and allegations of self-dealing.
Did CMBS 2.0 try to fix this?
They did try. Newer deals often have provisions that shift control up the waterfall before the current controlling class is totally wiped out.
How does that work?
It's often based on appraisal reductions. When a loan goes into special servicing, the property gets appraised. If the appraisal shows the property value has dropped significantly, creating an unrealized loss that eats into the controlling class's position, control might automatically shift to the next tranche up that still has value at risk.
Okay, seems logical. Give control to someone who still has skin in the game. But the sources said this creates new problems.
Yeah.
Yeah.
Because who does the appraisal? Often it's done by, or heavily influenced by, special servicer, who is appointed by the current controlling class.
So they might influence the appraisal value to keep themselves in control.
That's the potential dispute. Is the appraisal accurate? Or is it being managed to prevent control from shifting away from the incumbent controlling class, even if maybe it should? It just moves the fight to the validity of the appraisal itself.
Fascinating. Fixing one conflict creates another potential battleground. Okay, what's next? Waterfall disputes.
Right. These are described as almost constantly simmering in the background of CMBS.
Related to that payment priority we talked about.
Exactly. The legal documents governing the CMBS deal, the Pooling and Servicing Agreement, or PSA, contain incredibly detailed rules about how every dollar coming in, loan payments, liquidation money, and every dollar of loss gets allocated among all the different tranches.
Must be pages and pages of rules.
Oh, yeah. Super complex. And even with careful drafting, there can be ambiguities or situations pop up that the documents didn't perfectly anticipate, especially when loans get modified or the market gets weird.
And you said these are expected to increase. Why?
Because loan modifications are expected to skyrocket in times of distress. When the special servicer changes the terms of a troubled loan, maybe lowers the interest rate, extends the term, defers payments, how exactly does that change impact the cash flow distribution down the waterfall?
Different tranches might have very different opinions on that.
You bet they do. Each tranche holder will argue for an interpretation of the complex waterfall rules that benefits them the most. It becomes a fight over how the modified cash flows or any eventual losses get sliced up. The sources mention cases like U.S. Bank versus SBMC Holdings involving exactly these kinds of fights over modifications and the waterfall.
So trying to fix a problem loan can actually trigger a new fight among the investors.
It happens all the time. And it's not just modifications. Any kind of borrower issue that interrupts cash flow or causes a loss can lead to arguments about how the waterfall rules apply in that specific situation. More borrower distress means more potential triggers for these allocation fights.
Okay, moving on. Busted deal disputes. What happens there?
This is when a planned CMBS securitization basically falls apart before it even gets launched.
How?
The sponsor lines up all the loans, maybe even structures the tranches on paper, gets everything ready to go, but then the market suddenly turns sour. Investor demand disappears, or market volatility makes it impossible to sell the bonds at reasonable prices.
So the whole deal just gets canceled mid-process?
Yeah, it gets busted. They're stuck with the loans they bought, but no way to package and sell them as CMBS.
And the dispute?
It often involves things like deposits or commitments made along the way. The Cascade Funding versus the Bancorp Bank case mentioned in the sources is an example. A CMBS issuer had put down a big deposit, like $12 million, with a bank providing a huge pool of loans, $900 million worth, for a deal that then failed due to market disruption. The fight was over who got to keep the deposit based on the contract terms about market conditions.
So even the failure to launch a CMBS deal can lead to litigation during volatile periods?
Absolutely. These agreements often have specific clauses about what happens if the market tanks, and interpreting those clauses can lead to big fights.
Okay, then there are disputes related to how investors finance their CMBS holdings, repo and margin calls.
Right. A lot of big players like REITs or hedge funds don't just pay cash for their CMBS bonds, they often finance them using repurchase agreements or repos.
How does that work again?
It's basically a short-term loan. The investor sells the CMBS bond to a lender, usually a big bank, with an agreement to buy it back shortly after at a slightly higher price. The CMBS bond acts as collateral for that loan.
Okay. So where's the dispute?
It happens when the value of that CMBS bond collateral drops, or the lender thinks it dropped. If the market gets volatile and CMBS prices fall, the lender will demand more collateral. That's a margin call.
They want the investor to put up more cash or bonds.
Exactly, to maintain the safety cushion on the loan. Disputes flare up when the investor disagrees with the lender's valuation of the CMBS collateral. Especially in stressed, illiquid markets, figuring out the true value of a CMBS bond can be really tricky and contentious.
So they fight over how much the collateral is actually worth and therefore whether the margin call is justified.
Precisely. The AGMIT CMO versus RBC case was cited. Involving exactly that kind of fight, did the bank unfairly mark down the collateral value during market turmoil, triggering huge margin calls. It shows how stress in the CMBS market itself creates problems in the financing layer on top of it.
Man, layers upon layers of potential problems. Okay, let's talk about what sounds really serious. Fraudulent selling or misrepresentation claims.
Yeah, this goes to the heart of the information investors rely on. The sources discuss a whistleblower complaint filed with the SEC by a CMBS market veteran named John Flynn.
What did he allege?
He alleged, supported by reporting from ProPublica that looked at loan documents, that there was a widespread practice of basically fudging the numbers on the underlying loans going into CMBS deals.
Fudging what kind of numbers?
Key metrics like the borrower's net operating income, NOI, being inflated, property occupancy rates being overstated, maybe the borrower's other debts being understated.
Why would they do that?
To make the loans look less risky than they really were. If a property seems to be generating more income, it can justify a bigger loan amount, or just make the loan look more attractive to package and sell into a CMBS pool.
That sounds like outright fraud, potentially. Misleading investors about the fundamental quality of the assets.
It's a very serious allegation, and the sources cited an academic study that actually found a link. Looking at older CMBS deals, the study found that NOI was often overstated, and crucially, that overstatement correlated with higher default rates later on.
How strong was the correlation?
The study suggested every 1% that NOI was overstated was linked to about a 20% higher chance of that loan eventually becoming delinquent.
Wow. So dishonesty at the start could directly lead to investor losses down the road.
If proven, absolutely. This kind of alleged misrepresentation could lead to major lawsuits against the issuers or sellers of the CMBS bonds. Investors could argue they were tricked into buying based on false information, or that the sellers breached contractual promises about the loan quality.
Has this happened before? Successful lawsuits?
The sources mention an SEC case against Nomura, SECM, as an example where regulators successfully went after participants for misleading investors about CMBS. So it's a known risk area.
Okay. And finally, repurchase claims against originators. How does that fit in?
This is about pushing liability back up the chain. Remember how originators sell loans to the CMBS issuer?
Yeah.
Well, in those sale agreements, the originator usually makes certain promises, representations, and warranties about the loan's quality. Things like the income figures are accurate, underwriting guidelines were met, etc.
Okay.
And often these promises mirror the promises the CMBS issuer then makes to the investors about the loans in the final pool.
Ah, a pass-through of promises.
Kind of. So if the CMBS investors later sue the issuer, saying, hey, you breached your warranty, this loan's NOI was inflated.
The issuer might turn around and sue the original lender.
Exactly. The issuer files a repurchase claim against the originator, saying, you breached your warranty to me when you sold me this loan, so you need to buy it back or cover my losses.
Trying to make the originator responsible for the bad loan?
That's the idea. It's a contractual way to seek recourse. Now, the sources point out this might not always work, especially if the originator is small and goes bankrupt during a crisis.
Can't get blood from a stone.
Right. But CMBS loans are big. A repurchase claim on even one large loan against a solvent originator could involve millions of dollars. So it's definitely a potential area for disputes when loan quality issues surface.
Okay. So putting it all together, it seems like stress in the commercial property market can really expose a whole host of potential legal weak spots all through the CMBS system.
It really highlights the complexity. You've got fights over control, fights over how the money gets split, fights over deals that never even happened, fights over financing, and even fights about whether the basic information was accurate to begin with.
Which kind of leads to a big question the sources raise. How will the newer CMBS 2.0 structures and things like risk retention actually hold up under severe stress? Will they lead to fewer disputes or just different kinds of disputes compared to the last crisis?
That's something the market is still figuring out. The legal implications of all these changes haven't really been fully tested by a major downturn yet.
Okay, wow. That was definitely a deep dive. Lots of layers there. Let's try to pull out the main takeaways.
Sounds good. So first, CMBS, they're bonds backed by pools of commercial mortgages. Simple concept, complex reality.
And the absolute key to understanding them is the tranche structure, slices of risk, slices of cash flow.
Right, governed by the payment waterfall. Senior tranches at the top. First paid, last to lose money, safer, lower yield.
Junior tranches at the bottom. Last paid. First to lose money. Riskier, potentially higher yield.
We also saw how CMBS are different from RMBS. Fewer, much larger loans, different data, which means concentration risk is a bigger deal and fights over single loans are more common.
And market stress, like the sources described from 2020, can cause delinquencies to spike rapidly, especially in vulnerable sectors like retail and hotels back then. Predictions were grim, potentially worse than the last crisis, partly due to less government support initially.
Then there's the regulation. Dodd-Frank's risk retention rule, that 5% skin in the game requirement, met vertically, horizontally via B-piece buyers, or L-shaped, designed to make issuers more careful.
And studies suggest it might be working, leading to somewhat more conservative underwriting, maybe higher quality loans.
But even with all that, stress creates legal friction points. We talked about disputes over control of troubled loans and special servicers.
Complex fights over interpreting the waterfall rules when loans get modified.
Deals that fall apart before launch.
Margin call disputes related to investor financing.
Allegations of outright fraud or misrepresentation in the loan data.
And issuers trying to push losses back onto the original lenders through repurchase claims. A whole menu of potential litigation.
So if you take a step back, what's the big lesson here? Why should you care about these intricate layers?
Well, I think it really shows how interconnected everything is. Trouble in commercial real estate doesn't just stay there. It flows through these complex financial products.
Right.
Potentially hitting pension funds, insurance companies, banks. The ripple effects can be broad.
And the very mechanisms designed to manage the risk, the tranches and waterfalls, can themselves become the source of conflict when things get tough. The complexity cuts both ways.
It really makes you wonder, doesn't it? Even with the post-crisis fixes like risk retention, how well can these structures really handle major unexpected shocks? And how much transparency is actually there when you see potential fights over valuations or basic data accuracy?
It underscores the need for serious due diligence, for really understanding what's inside these things, especially when times are uncertain. You can't just rely on the ratings or the surface-level description.
Absolutely. Critical thinking, questioning assumptions, it seems essential in this market.
For sure. And even with skin-in-the-game rules, valuing and managing all the different risks packed into a CMBS deal remains a huge challenge, constantly evolving.
It's a powerful reminder, I think. Financial innovation can unlock capital and create markets, which is good, but it also creates these new, sometimes hidden interdependencies and vulnerabilities. You only really see how strong the system is when it gets stressed.
Well said. It's definitely a continuous learning process for everyone involved.
Always more to dig into. That's all the time we have for this deep dive. Thanks for joining us.
My pleasure. Thank you.